this is Jim Mitchell. Today we're going to talk a little bit about how to determine what kind of permanent insurance an individual may need, or the differences between the two types of permanent insurance. In prior classes, we've talked about term insurance. This time we're going to be talking about permanent. And what you need to understand is that the word kind of speaks for itself. When we look at insurance, we're looking at the insurance that we're going to need permanently. Okay? So if we get to a situation to where the decision is, well, I have term insurance, my kids are gone, I don't need permanent insurance, you're going to find that there's going to be many, many reasons to have permanent insurance. So before we talk a little bit about permanent insurance and the needs for it, we'll talk about what are the things that you're looking to insure. Well, one of them could be a pension, and for many of our clients, they have what's called a defined benefit pension, where they get a certain amount of income, and it's reduced if they buy a spouse benefit. So the example would be you get a pension from your employer or a pension from the state, and they provide $2,000 a month. But if you buy a spouse benefit, it's going to cost $500, and then your spouse would get $1,500 in the event of your death. Well, basically all that is life insurance, okay? The problem is when you retire at 60 or 65, you may not have good health to be able to have the permanent insurance. I find that about 50% of our clients do not qualify for it. They have to buy the insurance from the state, which is extremely expensive. Now, so you're going to be looking to insure the pension. The other thing you're going to be looking at is going to be Social Security. And why would anybody want to do that? Well, I'll give you a good example. I'll take myself as an example. My wife gets $1,280 a month Social Security. Okay? So she's worked most of her life. She's now 66 years old. She can get $1,280. She can earn as much money as she wants to. And so she gets $1,280. I'm 62, so she married a little bit younger person. So I get $1,250. In the event of my wife's death, I get her $1,280, and the $1,250 basically goes away. So I lose $1,250. That is something, if I want to make sure that I can get by, I may need to have my wife, or I make sure that I have insurance to protect my wife. Now, that's what I've done, is I've protected my spouse, but I'm going to do my best to try to encourage my spouse to increase her protection, to protect us and the family against the possibility of losing her retirement. Okay? Now, when we talk about permanent insurance, we basically want to put ourselves into a position to where we really understand that it works something like this. Universal life, I'm going to draw the same thing that I do for many, many years. Okay, and it'll depend upon what your agent does, but a universal life policy basically works like this. If I put in $150 a month, okay, let's say I have $150,000 worth of coverage, and everybody's age and the figures are going to be different, but you need to work with your financial advisor and your insurance advisor to be able to determine what would be best and how much you need to have in permanent insurance past retirement. The younger you buy it, the better off you are. But $150 a month goes into the universal life bucket, we'll call it. And let's say the cost for the insurance is $50. So what happens is that $150 of premium goes into the bucket. So we have $150. And then $50 is going to come out of the bucket on a monthly basis for the actual insurance cost. That's going to leave $100 a month accumulating at interest. Okay? Now, that $100 a month allows you to build values in there that can help keep the premium, because what happens is this cost of insurance is like a term premium. So it's a little more expensive now and less expensive later. But bottom line is, as you build values in the account, it will help to pay the premiums later. There's many variations. We talked about deferred comp and a few other things, but this is just straight buying life insurance, universal life, making sure it lasts till your age 120. So, bottom line, it builds values. You have access to those values during the early years. In later years, you may need to use those values to help pay the premiums and the cost of the term insurance. It's designed to be there for the rest of your life. That's the whole significance of it. So under the new rules, you can pay that $150, and basically that'll guarantee you insurance, or could guarantee you insurance, till you're 120 years old. So that's term for really life. Okay. So depending upon what you're trying to accomplish, you can do some amazing things. So, for example, in this example, you might be putting in, and you might buy an insurance policy for $150, but the IRS will allow you to put up to $500 a month into the account. Well, when you do that, it changes more to an accumulation account rather than just a life insurance. So what we're really talking about is just permanent life, okay, and the needs that you may have to insure to have permanent insurance after you retire or when you retire. Okay? So thanks a lot. I hope this will make some sense. Bottom line is you need permanent insurance when you're retired, just as you need insurance when you're young. Have a great day. Talk to you later.